Hi, everybody. This is Fred Bruin of the Remax Parkside Real Estate. It is Wednesday, May 6th, and I'm still in great need of a haircut. I'd like to take a few minutes to talk to you about unemployment and how it may or may not affect the housing market. I've got a couple of slides to share with you, of course. I'd like to talk to you about Friday, May 8th. That's this Friday coming up. That's the day that the unemployment numbers for April are going to be released, and it's going to be brutally ugly. We already know that going in. It's going to be interesting to see how the stock market reacts on Friday. These smart people here think that number is going to come out somewhere between 15 and 20% unemployed for the month of April. But there is a little bit of light. This is the number of weekly unemployment filings. So we can see the week of March 28th, we were up at about, here we go, 6.9%, but it's been slowly tapering off the number of new filings. Not brilliant, but at least it's headed in the right direction. How does this affect the housing market? Well, let's take a look at a couple of issues here. This is Carlos Rodriguez says. Carlos is the CEO of the Automatic Data Processing Company. They're one of the largest payroll processing companies in the United States. And based on what they're seeing there, it's possible that companies are already anticipating some kind of normalization, opening in certain states and starting to post jobs. So they're posting jobs, starting to hire back, and the number of layoffs is decreasing. So that's also a positive sign. Let's look at history here. So again, Goldman Sachs and JP Morgan are predicting that the rate of unemployment, of course, we know is a severe increase in the immediate increase in the number of unemployment, the rate of unemployment, but they also see a very quick recovery when you compare that to how the Great Recession and the Great Depression was stretched out over several years. So again, short-lived high unemployment. And then on the housing side, in the housing market, on the economic side, just like on the structure of the house, you need to have a good foundation. I believe that on the economic side, a good foundation is your equity value. And this is a percentage of homeowners' equity value in 2020. And this is an interesting pie chart. It's showing us that 42% of homeowners out there or homes out there have zero mortgage or 100% equity. Then 16.6% have 60 or better percent equity value. If you combine these two together, we're looking at 58.7. So well more than half have 60% or better home equity value. And then if we add in these two slices of pie, we're talking about 86.6% of homes out there have 21% or greater equity value. Very hard to walk away from that very strong asset. And this slide says pretty much the same thing, but I wanted to point out this little corner right here. So if a home has a mortgage on it out there in the United States, the average equity value is $177,000. I'll say that again. If there's a mortgage on a house out there, the average equity is $177,000. That's a very strong equity position to be in. Our real estate market is in today. And that's why I believe that this short-lived unemployment issue is not going to affect the housing market, and it's not going to last long enough to start putting downward pressure on housing values. That's it for today. Thanks for watching, and we'll look for you next time.